welcome to Clatch Radio. Today, we're doing a dive into Clatch LLC. They're a quantitative investment firm, been really making some waves since they launched, June 2020?
That's right. Yeah, June 2020. And we've got some interesting stuff to look at their own documents, academic case studies too.
Right. And our mission really is to figure out how they're pulling off these average annual returns consistently above 24%. Seems like a mix of tech and discipline in options trading.
Exactly. And the consistency is key. They specialize in probability-based options trading, mainly U.S. markets. We're talking about 20,000 contracts a year.
Wow.
Yeah. And it's all through their own automated system. It's self-funded, clearly built for scale, which probably explains why they're looking for partners now.
Okay, so what's the secret sauce then? I gather there are a couple of core proprietary tools involved.
That's right. At the heart of it, yeah. First up is something called the cone of profitability.
The cone of profitability.
Yeah, and it's more than just a catchy name. It's a specific analytical tool they developed. It forecasts a stock's likely price path.
And it's pretty precise, I understand. They talk about a bobby pin shape.
Exactly, that's the visual. It gives a much tighter, sort of more predictable range than your standard statistical models. Makes finding reliable trades easier. There was one example where it predicted a stock would stay above support 97% of the time. Pretty specific.
Impressive. And flowing from that?
Flowing from that is their in the money or ITM probability metric. And this is, well, it's a bit of a game changer.
How so?
Because it gives them a single intuitive number of probability. It basically helps sidestep getting bogged down in all the complex Greeks, delta, gamma, all that stuff that measures option sensitivity.
Right, the standard metrics.
Yeah, so this ITM probability simplifies the decision-making, makes it faster, maybe less prone to emotional errors in the heat of the moment.
Okay, makes sense. So foundational tools, cone and ITM probability, how do they actually, put these to work? I saw a case study on McDonald's.
Ah, yes, the McDonald's MCD case study. That really shows their main income strategy. Over a year, May 2024 to May 2025, they hit a 99.05% success rate.
99% on how many trades?
That was 312 out of 315 trades expiring out of the money. And overall, with trades and rolls, 392 actions yielded over $21,000 just on MCD, consistent income generation.
How do they manage the position so effectively? Rolling strategies.
Exactly, adaptive rolling. If the stock drops, they use forward rolls, extending time or lowering the strike price. If it rallies, they use backward rolls to capture profits.
And I saw something about cross-asset rolls.
Oh yeah, that's quite innovative. Cross-asset rolls to SPY. Basically, if things get tricky with a single stock like MCD, they can shift the risk exposure to the broader market index, the SPY. They had over 3,000 SPY trades expire worthless too, supporting this.
Interesting. So beyond that core income play, do they have other specialized strategies? I saw one called the Iron Bronterock.
Yeah, the Iron Bronterock, great name. Named after some mythical doom bird, apparently.
So it bets on disaster.
Actually, no, quite the opposite. That's the interesting part. It's market agnostic. Doesn't care about direction. It hunts for irrational price differences between put options on the SPY and the QQQ.
So S&P 500 versus NASDAQ 100 puts, looking for mispricing.
Precisely. They use what they call the Fondo methodology to spot wealth cross signals. That's basically when QQQQ puts get unusually expensive compared to SPY puts. Like the premium ratio goes above 110%.
And they jump on that.
Yeah. Targeting options with really low ITM probabilities, under 1%, it acts almost like a low-risk hedge. And these chances pop up pretty often, maybe 3 to 5 days a week.
Fascinating. Okay, one more strategy you mentioned was cap shift. What's that about?
Right, cap shift. This one's different. It's an overlay strategy for managing naked short puts.
Which are inherently risky, right? Selling puts without owning the stock.
Exactly, potential for big losses. So cap shift aims to turn that into a defined risk structure that still generates income. Unlike rolling, it's additive. It layers a protective spread around the original short put.
And how does it adjust?
It's driven by that ITM probability again. If the market drops, it can cap forward to extend the protection. If things are stable, it caps back to harvest premium more efficiently. It's all about, engineering that efficiency within defined risk limits.
Got it. And managing all these positions, especially getting out of them efficiently, relies on automation.
Absolutely. They have sophisticated automated exit systems, 2 main ones. For uncovered short options, there's Nickelback.
Nickelback, like the band.
Yeah, maybe. It places an order to buy back the option at 5 cents, 0 to 5 cents.
Why 5 cents?
because some brokers, like Schwab apparently, don't charge commissions if the closing price is 0.5 or less. So they capture almost all the original premium minus 5 cents with no extra trading cost. Pretty clever.
That is clever. And the other system?
That's Pennywise. For covered short positions, this one aims even lower, placing the buy-to-close order at just 1 cent, 0.01 cents.
Maximizing the profit down to the last penny. Essentially, yeah. Capturing the last cent of premium with zero downside risk at that point. Both systems are managed weekly, usually Sundays. But importantly, the orders get canceled if there are less than 10 days left until expiration.
Why cancel them then?
Because the tiny premium left isn't worth the potential commission cost, even if it's small. It avoids pointless transaction fees. Again, efficiency.
So wrapping this up then, what's the big picture takeaway for you listening? Well, I think Clatch really shows what happens when you combine unique tech, like that cone and ITM probability, with very systematic, data-driven strategies and automation.
Right. It leads to that remarkable consistency and pretty solid risk management, even in complex option markets. They really are engineering efficiency.
Definitely.
Thank you for listening to Clatch Radio.